Okay. Okay. Good morning, everyone. Brian? Okay. Starting this mic, come on down, Haley. I've got Haley here with me today. She's going to be in class with us about 1 day a week. And she is going to tutor for our class. And she's going to come to class so you get to know her. Haley is a senior accounting major, and she's going into the master's program next year, so hopefully next year she'll be grad assistant. But I know her quite well. She was in my FYE class. If you're online, this is a picture of Haley, and she'll be offering tutoring. I'm going to be sending an announcement out this afternoon about tutoring. Tutoring will be available on Tuesday and Thursday afternoons and Wednesday mornings. I'll send the exact times in the email. You will have to sign up each week for tutoring. There'll be 6 different sessions from which to choose. Each session is the same. If you want to go to more than one session, that's fine, but they will be the same. So this is Haley, and she's going to be, when we do the questions in class, she's going to take half the class. I'll take the other half of the class. You can also ask her questions about the class. She took my class a couple years ago. She was in my FYE class, and she went to Europe with me for the accounting study abroad. So I know her quite well. And well, Brian's telling you he did too. By the way, if you're an accounting major, something to think about. I do take a group of accounting majors every May. We leave the Sunday after finals week. We go for 2 weeks to Paris and London, and this year we're going to Scotland. I think next year we'll go to Paris, London, and Dublin. But we go for 2 weeks. And we visit some accounting sites, we visit some accounting firms. It's an excellent trip, and it's for credit. There's scholarship dollars available to help pay for it, and it counts as an accounting elective. So both Haley and Brian have done it. I took 12 the first year, I took 15 last year, and then this coming May I'm taking 24. So this is for primarily accounting majors. If you're finance or CIS, you can get in, but preference is given to accounting majors. I think this year out of 24, we have 23 accounting majors. So and I'll be talking more about that as the semester goes, but it was just on my mind. I was reserving tickets this morning. So anyways, so we've got Haley, so she's going to be here with me in class, and Brian will be here every day. Haley will be here 1 day a week, and then tutoring the other times. Okay, so we're going to start out class with a question. Okay, so the question is going to appear. It will appear there. Okay, I can see it on the screen. Yeah. Okay, so we're going to start with the true-false question. So this relates to the chapter 1. You would have watched the video on this and videos on this and read the chapter. So the true-false question. And it's all corporations must use the calendar year, meaning January through December, as their accounting year. Okay, true or false? Okay, so what do you think? False? Okay. False? Okay. True? Okay. You change to false. Okay, false. What do you think? False? True? Okay. False? False? Why false? Okay. What do you think? Okay. Haley, what are you getting? All false? I got mostly false, and I got a way false. Brian?
I have 36 false and 4 true.
Okay. And the answer is yes, it is absolutely false. Okay? You do not, as a corporation, you do not have to use the calendar year. corporations cannot change their year at will. You can't have February to January one year and then change it to another thing the next year. You typically, you pick your year and then you stick with it. Now, just to illustrate this, a lot of companies have a lot of different accounting years than, let's see. So first of all, just some example year ends. Amazon, this will catch up with me. Amazon has a December 31st year end. Then the next one, Nikon cameras, they have a year end of March 31st. So their year runs to March 31st, and that's the end of their year, so the 12 months ending March 31st. And I'm not going to test you on what the year ends are these companies. I just wanted to show you there's some interesting year ends. Kent State's year end is June 30th, and that makes sense because it kind of follows our operating cycle. We wouldn't want our year end right in the middle of the academic year. So typically when you see a university, you're going to see a June 30th year end or a May 31st year end. Okay, GameStop and Target are kind of interesting. GameStop and Target have a year end that is the Saturday that's closest to January 31st, and it's either 52 weeks or 53 weeks. And it's just kind of weird, but you can do your year end like that. And Target has the exact same year end. It's actually fairly common for a retailer because retailers want to get that the returns period from holidays in their year end. So it would be a retailer, if they cut off their year at December 31st, they're going to have a lot of returns in January that match it. So Vail Resorts, the ski place, they have July 31st. Again, they wouldn't want their year end in the middle of ski season either. So that's just an example. You do not have to have a calendar year end, and many companies do not. So those are just some examples. And you do not need to know any particular company's year end. Okay, those are just examples. Okay, so what we're going to start by doing, we're going to do several homework problems today. So the first one is short exercise 1-10. Do we have a question? So if you want to sit down there, you can actually use the keyboard on the big computer if you want. Okay. Okay, so short exercise 1-10 is we are going to be doing several statements today. There's 4 main financial statements. The first financial statement, and they have to be prepared in a certain order. The first financial statement is an income statement. An income statement is the first financial statement, and it tells us how we did last year. And then we're going to go to the statement of retained earnings or statement of stockholders' equity. Statement of retained earnings is kind of a subset of statement of stockholders' equity. In this class, we're kind of using them interchangeably. Then we go to the balance sheet, and then we go to the statement of cash flows. We're going to illustrate the first 3 today. So this is the first one. We're going to see this over and over through the whole semester. In fact, what we do today we'll see over and over through the whole semester. So this is the first statement. This is the income statement. So it tells us that we began 2012 with total assets of $100 million, ended with total assets of $190 million, and then tells us about revenues and expenses, and they paid dividends. And they said, prepare the company's income statement for the year ended December 31st, 2012. Okay, so there's lots of things we need to know about statements. The first thing is an income statement. The very first line in the heading of an income statement, of any statement, is the name of the company. Okay, name of the company goes first. When you do your homework, when you fill out the income statement, you have to pick the name of the company first. This is not a random order. This is very specific. Financial statements are designed to be used by outsiders, so investors, creditors, other people that are using those financial statements. They need the information in there. So there's standardized ways those financial statements are presented, and this is one of the standardized ways. The top of the statement will always be the company name. The second line will always be the name of the statement. These cannot go in other order. They have to go in this order. So we have the name of the company, the name of the statement. The third line down is the date line. The date line is also a very specific line. An income statement says, here's your income for the period. Now we don't notice it doesn't say just December 31st. That's because this income is not for just December 31st. This income is for the whole year. So it always specifies the period of time for which this statement is. So this statement is going to start with, is going to be for the year ended December 31st, 2012. Of the 4 statements we do, 3 of them have for the period ended. So 3 of them are for period ended. We'll do the one today in a little bit that's as of one particular date. Okay, so then first item on an income statement, it doesn't matter, any for-profit corporation, the very first line on their income statement is revenues. It can also be called sales. It can also be called sales revenues. So it's sales, revenues, something like that. That is going to be the first item on every income statement. Okay, notice that it says millions above there in that column. That's telling you that 6 zeros have been omitted from these numbers, because otherwise it gets pretty cumbersome to read. As an aside, My Accounting Lab, generally when you do this homework problem, it's going to be different numbers, but it's also in millions. Don't add 6 zeros, because then you're talking about quadrillions or whatever that number would be. So do not add zeros. If you ever have a question about how to put the numbers in My Accounting Lab, click on Help Me Solve This. It'll show you a model, and it'll be some number similar to 97. The numbers will be different. So our income statement to date, to this point, we have the name of the company, the name of the statement, the year-ended date, telling us what period this income statement's for, and then our first line is revenues. Now this very first income statement we're doing, very, very basic. We have 2 lines on it. The next line down is going to be our expenses. Okay, and this just has 2. We get many more accounts later on, but for right now, the basic format of an income statement is to have revenues minus expenses. So this is our most fundamental income statement format. Revenues minus expenses is going to give us our net operating income, okay, net income. So a couple things to note. We have, when we're adding or subtracting numbers in a column, we do a single underline right when we mean to do that operation. So we have 97 minus 26. We draw a single underline, and then we put the 71. The double underline under the 71 means we're done with this statement. That is the end of it. Okay, that total's done. Typically, but not always, we'll have dollar signs at the first number in the column and for every total. In My Accounting Lab, you're not going to have to worry about dollar signs or the underlines. I'm just explaining to you why this looks like it does. The underlines are quite helpful. If you see an underline in My Accounting Lab, you're filling out a schedule. An underline means that you're adding up or subtracting things above that. The double underline means this is the last total on this particular statement. So do watch for that if you're filling out like a blank sheet and you see that single underline and the double underline, your total for that statement goes on that line. Okay, notice we do not put brackets around expenses. This is because informed users of statements expect expenses to be subtracted from revenues. If you have a negative expense, it's possible it could be an error correction. So a negative, putting brackets around that would mean something completely different. Okay, so that's the most basic format of an income statement. I would absolutely positively know how to get net income, this basic format. You're going to do this homework problem is on your homework. It'll go pretty quickly because it's going to look pretty much just like that. There is I believe there's actually blank lines, and you actually, on this one, the trick in my accounting lab, I believe, unless they've changed it, is look for the line where net income goes. Look for the single underline and the double underline. That line has to be your net income. You might have a couple blank lines after expenses till you get down to that bottom. So that's just in terms of input. Okay, so now we're going to do another question. So leaving the income statement for a moment. So ignoring your notes for the moment, let's see if you can figure out what net income is. Net income, how do we compute net income? What is it? Is it revenues minus expenses minus dividends? Is it B, revenues plus expenses, C, revenues minus expenses, or D, revenues minus expenses plus dividends? Good one. Okay, I'm going to start. Hello. So what do you think?
I'll go with D.
D? Okay. What do you think? C? 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 Okay. Okay. C? Okay. Brian, what do you have?
I have 71 C's, and the rest is just like 2 or 3 of A and B. Not a big deal. So, C's.
Okay, Haley has mostly C's, some A's and B's. I had overwhelmingly C's, and the answer indeed is C. And I do want to take this time to explain why it's not the other answers. We didn't specifically address it. The income statement is revenues minus expenses. Their dividends are considered to be a return of capital. Dividends appear on the statement of retained earnings and on the statement of stockholders' equity. Dividends never, ever, ever appear on the income statement. Dividends never impact net income. That's one of those rules you could put off to the side. You will probably see a question on an exam about it or on a homework problem. Dividends never ever are on the income statement. Dividends, what dividends are is when we see the word dividends. That's dividends that this company is paying its shareholders. If this company pays its shareholders, that's considered to be a return of their investment. It is not an expense of the company, because the company could do all kinds of weird things if they could create expenses out of dividends they pay their shareholders. So, whoops, that was nice. That was me. I squeezed the remote, so I guess I think I'll change this. There we go. Okay. 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 So net income, it never, ever, ever includes dividends. Okay. Okay, so then we have another question before we go on. And this one says, when total expenses exceed total revenues, so think about your expenses are larger than your revenues, what's the result? A net profit, a net loss, a dividend, or retained earnings? What do you think? B? Okay. B? Pardon me? B? Okay. Okay. How are you doing online, Brian?
I have 77 B's and no other answers, so must be fairly easy.
Okay. Haley? Mostly B's? Okay. Yeah, we got mostly B's, and that is because it is correct. B is when your expenses are greater than your revenues, the answer is a net loss. Just as an aside, retained earnings is actually a balance sheet account that's a running total of all your income to date minus any dividends you've paid out. So retained earnings is a balance sheet account, but a net loss is kind of the opposite of net profit. Okay, so now we're going to go on to the next financial statement, and we're going to use homework problem S1-11 for it. Okay, now, next we would do the statement of retained earnings. When we get further into the course, we'll be using statement of stockholders' equity. Statement of retained earnings is technically a statement of stockholders' equity, but for right now, we'll just refer to it as statement of retained earnings. This company began 2012 with retained earnings of $290 million. So that's the beginning retained earnings balance. Tells us revenues during the year were $360 million, expenses totaled $250 million, and they declared dividends. What was the company's ending balance? And we're going to prepare their statement of retained earnings. Okay, so first thing we do, we have to do the statement headings, just like we did with the income statement. So the first line is always going to be your company name. And that doesn't change. Every statement we do, the very first line is the name of the company. The second line is the name of the statement. So we have the statement of retained earnings. And then the third line is the date line. And retained earnings, we're going to be looking at what happened to retained earnings over the entire year, the activity there. So this is a year ended as well. So income statement is for the year, retained earnings is for the year. Note that we could prepare statements for a quarter, we could prepare them for a month, so the date line is whatever period of time is being presented here. But when we have an income statement and a statement of retained earnings, they're for a period ended. Okay, and again, we're leaving off millions. Okay, so first line on the statement of retained earnings is going to be the beginning retained earnings balance. Now we can, sometimes I shortcut it just by typing beginning RE, but we do, the formal way to write it would be retained earnings, December 31st, 2011. This is last year's ending balance. The balance that we ended last year with has to be the beginning balance for this year. So if we see the ending balance from last year, that's this year's beginning balance. So they gave us this in the problem, the $290 million. Now, for the next line of the retained earnings statement, we would add our net income. They don't tell us our net income, so we're going to need to calculate it. Okay? We need to calculate our net income. We just said that our net income is our revenues minus our expenses. So our net income is going to be our revenues of $360 minus our expenses of $250. So what we end up with on that next line then is net income of $110. Okay? So that was taking the $360 revenue minus the $250 expenses. So we have beginning retained earnings from this year, which is also the same as ending retained earnings from last year. We add our net income. The next thing we do is we subtract any dividends we paid. So we're going to subtract dividends. And it tells us in the problem dividends were 44. And we'll put brackets around that just because that's the convention. And then we would end up with our ending retained earnings then. Okay, so our ending retained earnings on December 31st, 2012 is going to be 356. So we're taking our beginning retained earnings, add our net income, subtract dividends paid. Okay, so far we've done two statements. We've done the net income, the income statement, where we know it's revenues minus expenses equals net income. We've done the statement of retained earnings, which is beginning retained earnings plus net income less dividends equals retained earnings. You see why the reason we have to do the statement of retained earnings after the income statement is the second line here, that net income line, comes from the income statement. So that's why this one comes after the income statement. Now, Haley, you don't have to get up for this one. This one's going to go really quick. I have a real quick question. It's a true or false. And remember, there's four statements. I said this a little bit ago. See, all financial statements are as of a specific date. True or false? False. Okay, all financial statements are as of a specific date. That is false. And the reason it's false is the balance sheet is as of one particular date. The rest, can we get that down? Okay. The balance sheet is the one that's as of one date. Every other statement is for a period ending. And that's an important distinction. When you do the homework, you'll have to do the statement headings, and you need to know if it's as of or for period ending. That's because the income statement, it makes a huge difference if I'm looking at income for 1 month or a year. If you think of your own income, there's a huge difference between your 1 month income and your 1 year income. Same with companies. So we tell the investor or the user what period they're for. The balance sheet, which we're getting to next, is the one that's different. The balance sheet says, this is what I own as of this one date. So that's where we're heading now. It's the third statement, the balance sheet. The balance sheet we're going to do with short exercise 1-12. The balance sheet is the different one in that it's as of a particular date. So what they have in this problem is we're told on December 31st, Landy Products has cash, receivables, and inventory, and they have equipment, accounts payable, long-term notes payable, and common stock. So it tells us to prepare their balance sheet with the proper heading. So this one's going to take several slides because the balance sheet is longer than the other statements. Again, this is a good one for giving you a good prototype for what a balance sheet should look like. Okay, so first thing we need to do before we go any further on this problem is we need to figure out retained earnings. And the reason I know we need to do that is the last line says, use the accounting equation to compute retained earnings. So in the first line, I put the accounting equation, assets equal liabilities plus equity. Okay. Now, equity is composed of common stock plus retained earnings. So then what that means is we've got this equation, assets equal liabilities plus common stock plus retained earnings. So we're just taking that basic accounting equation, expanding it a bit, because in this particular problem, they did not tell us what retained earnings were. But we can use it, we can use the accounting equation to calculate what retained earnings are. So what we're going to do first is we're going to add up our assets. So under assets, we're going to go through the problem and we're going to pick out all the assets. So we have cash of $12,000, receivables of $8,000, inventory of $44,000, and equipment of $88,000. Okay, and I'm still filling in the equation. So what I'm going to do next is I'm going to pick out the liabilities that were given to me in the problem. And the liabilities that were given to me in the problem, we have accounts payable of $13,000 and long-term notes payable of $80,000. So those will be my liabilities. So those are under liabilities on the other side of the equation. Okay? So we have the assets on the left side of the equal sign, and on the right side we have the liabilities, the accounts payable of $13,000 and long-term note payable of $80,000. Okay, now we're not done yet. We're still adding. And then we have common stock plus retained earnings. So we would want to put in common stock next. So we have common stock from the problem that's given to us is $15,300, and we have retained earnings, which is what we're trying to solve for. Okay, so we've added the $15,300 plus the retained earnings. So all we've done is we have filled in the numbers for the accounting equation that were given to us up above. And what we're trying to do is we're trying to solve for retained earnings. So if we add the $12,000 plus the $8,000 plus the $44,000 plus the $88,000, and then bring over, subtract the $13,000, subtract the $80,000, subtract the $15,300. I didn't have enough room to make all those intermediate calculations, but we will get to the retained earnings of $43,700. Okay, so we've solved for retained earnings. So right up to this point, we haven't done our statement yet. We're just gathering the information we need based on what it told us to do in the problem. Okay, so that $43,700, we'll put it off to the side. We're going to use it when we get to it, but I wanted to do the calculation before we got to the statement itself. So now I'm going to erase this screen and we're going to start doing our balance sheet. And the first thing we're going to do for our balance sheet is we're going to do the headings. So the first line of the statement is always going to be the name of the company. The second line will be the name of the statement, so we have balance sheet. And then the third line is the date line. And the balance sheet is the only statement that is the only one of the four major statements that is as of one particular date, because it's telling us what were the balances on December 31st, 2012. What did we own? What did we owe? So that's what the balance sheet's telling us, our financial position as of that date. Okay, now the first section on the balance sheet are the assets. And the assets go in a particular order. The first group of assets are current assets. Okay, so we're in the asset section, and the first account on your balance sheet always is going to be cash. That's one of those things carved in stone. Your balance sheet is organized, the assets are organized from most liquid, closest to being cash, down to least liquid. So we're going to start with these current assets. Current assets are assets that are going to turn into cash within a year or less. So the very first account, always cash. Okay, you can mark that down. That will always be cash. It's the way the statement is done. So we have current assets, the first one cash, then receivables and inventory. Those are usually in that order. Receivables and inventory could be switched. They're not as carved in stone as cash. Cash is always going to be the first one. So what we're doing is we're listing our current assets from the problem that we were given. We have cash, receivables, and inventory. Those are all things that turn into cash within a year. We're going to sell our inventory within a year. We're going to collect our receivables within a year. So we're going to subtotal our current assets. Okay? So we're going to take the 12,000 plus the 8,000 plus the 44,000. We get our total current assets of 64,000. Okay. Now, there's lots and lots of balance sheet accounts. We don't have very many in this problem. We have one more asset listed, and it's our equipment, and our equipment's 88,000. So down below total current assets, we'll write a line for equipment of 88,000. So we have current assets. What we're doing is we're telling our investors, here's our resources that are turning into cash. Equipment's different because it's equipment. We're not going to turn it into cash. We're going to hold it for the long term, so it's listed separately. So then after that, we go on and we have total assets. Total assets are total current assets plus our equipment gives us 152,000. Okay, now the accounting equation says assets equal liabilities plus equity. Assets equal liabilities plus equity is the format for the balance sheet. So we have assets. Assets equal 152,000. The total of our liabilities plus our equity will be 152,000 as well. So the balance sheet is a formal way of representing the accounting equation. Now, I'm going to leave this slide simply because I'm out of room on the slide. The balance sheet's going to continue down below, so it would be longer. We'll just keep adding to it, but this one's going to go away just because I'm out of room. So I'm still on the balance sheet, but now what I'm doing is I'm moving on to liabilities. So we have assets, total assets, then we have liabilities, and then after the liability section we're going to have an equity section. So our next section is liabilities. And liabilities are also listed in liquidity order. Okay, so we're just moving down on our balance sheet. We're still on the balance sheet. We're right below assets. Liabilities are listed in liquidity order. The first liability we're going to list are going to be our current liabilities. And our current liabilities, the very first one is always going to be accounts payable. We may have notes payable or something like that. We could have some other current liabilities. In this case, we only have one, but we have total current liabilities. And then we have one long-term liability, which is our long-term notes payable. Okay, so we're going to add our 13,000 plus our 80,000 together, and we will get our total liabilities of 93,000. Okay, notice that total liabilities does not have a double underline under it. It's just a single underline. It's a subtotal because this part of the balance sheet is liabilities plus equity. We've only done liabilities so far. So next, I'm going to leave this screen again. I'm out of screen space, so I'm continuing right down the line, and I'm going to my equity section, my stockholders' equity section. We're going to list common stock. Common stock is first, and then retained earnings. Retained earnings at 43,700 was the number we computed first. The asterisk next to retained earnings is just to remind me that we calculated it. It didn't come from another statement we calculated at the beginning of the problem. It was just kind of a note to say we got that early in the problem. It's not part of the formal statement. Okay, so we have common stock that was given to us in the problem. We calculated retained earnings. Again, that asterisk is just my own note that we calculated that earlier. So we calculated the 43,700. So if we add the 15,300 and the 43,700 together, we get total stockholders' equity of 59,000. That has a single underline under it because this is the subtotal for stockholders' equity. Now the total of liabilities and stockholders' equity is, if we look right above, I don't have it on the screen here, but if we looked at our total liabilities were 93,000. So if we add the 93,000 plus the 59,000, we get 152,000. Our balance sheet is in balance because our total assets of 152,000 equal our total liabilities plus equity. Now, when the next screen I've got the whole statement. So we just went over, this is nothing new. I just wanted to point to pieces of it as we went. So the whole statement is coming up, and the first part of that statement is the asset section, and we can see that total assets, there's the whole statement together, but it was really too small to present it like that. So the top section of the balance sheet is going to be our assets, are 152,000. Then we have liabilities below that in the next section. Our total liabilities were 93,000. And then the last section was stockholders' equity. And once we got down to stockholders' equity, then we could calculate our total liabilities and stockholders' equities. Our balance sheet, the total assets have to equal the total liabilities plus total stockholders' equity. Okay, that's that accounting equation of assets equal liabilities plus equity. Okay, so that's where we got those particular numbers from. Okay, so far we've done a miniature income statement. We've done a statement of retained earnings, which is a type of statement of stockholders' equity, and then we've done the balance sheet. Okay, that's the third statement. The next statement would be the statement of cash flows. The statement of cash flows tells our investors where our money came from and where it went from, our cash, because more businesses fail due to lack of cash than income. So that's the fourth statement. We're not going to do the fourth statement until we get to statement of stockholders or statement of cash flows, because it's a little bit different. It's a little more complex than the first three. So the first three are done in that order, and then what we're going to do now is we're going to have a question. What do you think on this? Okay. What do you think on Okay, on this one, the income statement, it does measure operating performance. Income statements, how do we do? How did our sales go? How did our expenses go? Okay, so next we go on, yes. The statement of cash flows measures where your cash went. It doesn't measure performance. It measures, because you can get cash from issuing stock, and that's a cash flow, but it doesn't have anything to do with your operating performance. Okay. Okay, now this exercise, what we're going to do is we are going to go silent for a couple of minutes. I want you to try it because I'm going to go around and read off over people's shoulder on this one. So basically what it says is you're analyzing the statements, use the following abbreviations. Income statement, I think when I did it, I did RE for retained earnings, I for income statement, B for balance sheet, and then C for cash flows. I'm going to tell you there's three items that are cash flows. Okay, so I'm going to tell you those right now. I can't fill them in on the screen. The cash flow items, because we're not doing one of the statements right now, the cash flow items are item F. So F would have a C next to it. The other cash flow item is I, and then N, increase or decrease in cash, is also a cash flow item. So we have those three items that are cash flow items. Cash flows, a couple other items do show up on the cash flow statement, but there's other statements. So everything else is on other statements as well. So I gave you F, I, and N all on cash flow statement. So I'm going to go quiet for a couple minutes, give you the opportunity to kind of, from what we just did, figure out what statement or statements each of these items is on. Okay? So in the chat room, we'll let you know when we start this up again. What I'm going to do on this one is I'll tell you right now what question you're going to be answering. So instead of me walking all around, I'm going to start on this side. So you're at first. So I'm going to tell you what question you'll be answering and we'll come back to you so you know which one to focus on. Okay? You're going to be doing A, B, C, right, okay, D, and even if we mentioned it already, if I already gave you the answer, it's easy. Okay, you're E, F, your G, H, I, how far do we go? Okay, J, K, L, okay, and yeah, M and N. Okay, and then you guys will be off the hook the next class period. So now everyone will sit over here. Okay, okay. So now I'm going to walk through and I'm just going to ask you, and if you get it wrong, it's absolutely fine. There's no penalties here. So we're going to start with A. What statement would you find dividends on? Yes, the statement of retained earnings. A would be the statement of retained earnings because we saw that. When it says dividend, a couple things here. When it says dividends, that's referring to dividends we paid out. It is possible for a company to own stock in another company and have dividend income, but in that case, it would be called dividend income or dividend revenue. But if you see an account that's simply dividends, it's their own dividends that they paid out. So that will be shown on the statement of retained earnings. Also, this is where I'm going to add to it. Also, you're going to find it on the statement of cash flows. So you're going to have retained earnings and statement of cash flows. I don't expect you to know the statement of cash flows. That's why I'm telling you when you do this on the homework, there are two answers for dividends. It's statement of retained earnings and statement of cash flows. Okay, so that was A. If you missed one, at the very end of this, I'm going to put up one that has all the answers on it. So if you do miss it, we're going to see it. I just don't want to put it all up right now. Okay, the next one, salary expense. On the income statement, so the answer for B, salary expense is income statement. Very good. Okay, next, inventory, C. Balance sheet. Yes, that is right. Inventory goes on the balance sheet. D, right? Okay, D, sales revenue. How about income statement? Sales revenue is the very first item on an income statement.
Which is like sales to customers and that.
On statement, that's the income statement. The income statement has sales revenue minus expenses equals net income. Statement of retained earnings has beginning retained earnings minus or plus net income. So it's implied in there, but it's not specifically on there. So the answer for D, sales revenue, is income statement. Okay, now E. Who's E? You have two answers, so I'll just take one of them, if you can get one of them, okay? Okay, yes, excellent. So E, one of the answers is statement of retained earnings. This is for retained earnings, makes sense, right? Do you want to hazard a guess as to what other statement retained earnings shows up on? Let me see what you had. Did you have that?
I actually didn't get to that.
Balance sheet. Yeah. Okay, so when we see retained earnings, we're going to see it on the statement of retained earnings, and we're going to see it on the balance sheet. Remember, it's part of that stockholders' equity section. Okay, and you have a really hard one, right? F? Yeah, the statement of cash flows. I know you aced it. Okay, so F is statement of cash flows, yes. Okay. Net cash provided by operating activities is the first section on the statement of cash flows, actually. Okay, now, G. Give me one of the statements. Income statement. Give me another one that's on. Retained earnings. Give me another one. Cash flow, yes, yes. So for G, it's on three statements. The only statement it's not on is the balance sheet. So net income shows up on the income statement, on the statement of retained earnings, and the statement of cash flows. Okay, so next on to H, on to cash. What statement? On the balance sheet and cash flow. That makes sense, right? We haven't seen it, but it would make sense that we would see cash on the statement of cash flows. So balance sheet and statement of cash flows for H. You left out with I, so I'll answer it for you. Okay, so the I is C, statement of cash flows. Net cash used for financing activities, that's another section on the statement of cash flows. Okay, your J, so we have accounts payable. Balance sheet, yes, absolutely. Balance sheet is for J, accounts payable. Okay, moving on. K, common stock.
Balance sheet.
The balance sheet, yes. Common stock is shown on the balance sheet. Okay. L, interest revenue. Income statement, yes. Okay, and then you have M, long-term debt. Balance sheet, yes, yes. Yeah, and then N, the increase or decrease in cash is going to be on the balance sheet. Now something to note here, that increase or decrease in cash, that's actually the change in cash. That's why from the statement of cash flows, the change in cash is not necessarily shown on the balance sheet. So this I'm just kind of putting a placeholder. If you want to do a screenshot, there's your screenshot opportunity. Okay. Okay, we're going to do another question. Okay, so another true-false question. A corporation must pay dividends every year. True or false? What do you think? False? That is correct. A corporation doesn't have to pay dividends any year. A dividend is not a legal obligation until the board of directors declares it. So corporations don't have to pay dividends any given year. Okay, and then we have one last exercise to do for today. This one's pretty short, and it focuses on the accounting equation. The accounting equation is on the screen. We're doing exercise 1-16A. And the accounting equation says assets equal liabilities plus equity. You have to know that. We have to be able to rearrange it. Okay, so the assets equal liabilities plus equity is, for situation 1, what we're going to have here is we don't know, for Perfect Cleaners, the very first item, we don't know what their assets are, but they tell us our liabilities plus our equity. Our liabilities are 15, our equity is 18, so our total assets are 33. So take 2 minutes and try to calculate Ernie's Bank and Hudson Gifts. Okay, so do the other two. So this one you'll just do on paper. You won't be entering it in a poll or anything. So do Ernie's Bank, the second situation, figure out liabilities, and the third situation, figure out, for Hudson Gift and Cards, figure out the owner's equity. Remember, owner's equity is equity, stockholders' equity. They all mean the same thing at this point for us. Do you have these? Do you know what you're doing? What's the first one? Ernie's Bank, or the second one? Yeah. Okay. I like to check my answers too.
Here it'll be video, recording.
Do you have the third one?
Yeah.
What is it? Good. I'm a fan of you. Check it. Okay, so for Ernie's Bank, assets are 35. We don't know liabilities. Equity is 22, giving us the, for the second one, liabilities are 13. Okay, and then the next one, Hudson Gift and Cards, we have assets of 27, liabilities of 17, so that gives us our equity equal to 10. And then the question does ask, which company appears to have the strongest financial position? Explain your reasoning. Basically, Ernie's Bank looks to have the strongest financial position because liabilities are the smallest percent of total assets. They've got more owner's equity invested in them. And Ernie's Bank has the most equity as a percentage. So basically, Ernie's Bank, because of its greater percentage of equity, is going to be the strongest one. Okay, and so that brings us to the end of class. Does anyone have any questions before we adjourn? You could stop recording. Okay, I will see you on Thursday then.